Welcome to the Susan Brender Show. It's all about you. Featuring shows on health and wellness, the performing arts, politics, and people who inspire you to be your very best. And now, here's Susan Brender.
I'm Susan Brender, and this is the Susan Brender Show. I'm very interested in investment coaching and various things pertaining to investment, because today we have to deal with quite a lot since the new president has been elected and various other things are happening in our money markets, if you want to call it that. So that's why I invited Aman Raina to be on my show. He's an investment coach and founder of Sage Investors, a financial education company that works with individual investors to improve their financial literacy and behaviors toward money so that they can become successful investors on their own. Now, I want to welcome to my show Aman Raina.
Hi, Susan.
Good to have you on the show, Aman. You know, I've talked to some of your colleagues, and we've talked all about what's going on as far as the investment coaching and how it's different from traditional investment advice. Would you tell us that? What do you think about that?
Yeah, there is a bit of a mind shift that's going on out there in terms of the relationships we have with our financial institutions. If you want to, we can start from where we've been, and when we look at things from a traditional way in terms of how we, make investment decisions, how we invest, it's always been we've essentially, outsourced our decision making to a certain extent to third parties, to institutions and specific, people like financial advisors, brokerage companies. And it's all based on essentially a relationship of dependency, where when we come to a broker, we come to them, we want them to tell us what stocks to buy and sell. We want them to tell us how to structure a portfolio. And, we rely on them on sort of designing our investment plan and to a certain extent our path that we're gonna go. And that's pretty much how we've traditionally done that. And as we've seen over the last 10, 15 years, we've been through some serious stress points in the financial markets, and that's created a lot of angst, a lot of uncertainty. People have lost some money, and they're questioning the traditional relationship that we have in terms of making investment decisions. So they're looking for another way. Yeah. And this is where the whole concept of investment coaching has kind of emerged, where unlike traditional methods which emphasize a dependency on other people, investment coaching emphasizes an independency. And what we do, and what I do as an investment coach, is I try to essentially build up some of the core competencies that, from what I've seen in my experience, successful investors have. And I've kind of called it, and I've kind of framed into what I call the triple E, which is I find that successful investors tend to have three components. They tend to be educated, they tend to be empowered, and they tend to be engaged in the process. Now, in terms of education, it's not about, you have to go to like Harvard Business School to get a degree or get a PhD or, in finance or something to be a good investor. Far from it. It's all about understanding and developing some key, mechanical understandings of how investing works, in terms of, reading a financial statement, calculating some ratios, understanding what risk is, understanding how companies create wealth. That's the mechanical side of it that I teach. But then there's the other side of it too, that, from my experience, that is just as critical, which is developing people's behavioral attitudes towards investing, because it's really the secret sauce to me that separates just average investors from, the great investors, successful investors, is they have they're much more aware of a lot of the cognitive biases that really can essentially screw up our judgments. And it's basically the emotional side of making investment decisions. So I work with people to develop those competencies.
Yeah. Let me stop you here.
Sure.
Let's talk about something very specific. Now, in the old days, an investor hoping to get on the ground floor of, say, the next Google or Facebook had a couple of options. He would ask a friend about it or sign in with a big brokerage firm from handling the startup company's private placement. Now, has that changed? And what way should an investor try to get in on something that could really be good?
In terms of, identifying that next Google, well, first of all, it really, as I said, talks about the education side. It's just, first of all, how do you go out and identify that? Like, what are the, the qualities, the criteria that'll allow you to identify that? And that's where the whole, from, the education side of it is just understanding, various different kinds of metrics, different kinds of, being able to just pick up, a company's balance sheet or a financial statement and just be able to get a sense of, is this a good business or is this a bad business? Mm-hmm. So the tools and the mechanisms that we use to evaluate companies, I don't think have really changed. It's just really what's changed is the access to it. Technology has definitely leveled that playing field. Right. As you said, traditionally, if you were a very high net worth kind of person, had a lot of money, you had more access to, more proprietary information. But now with the internet, you can go, anywhere, and information is pretty much, you can find it anywhere. Now the key thing is, because there's so much more information out there and so much more, we have so much more access on it, right, you have to be able to filter out the good and the bad, because there's a lot of bad information out there.
But how do you do that? I mean, because it's, as you just said, there's a lot of bad information out there, and sometimes financial advisors and brokerage houses, they want to sell a product,
right,
and it may not be a great product for the person who's investing.
Right, and that's kind of what I do in terms of what I do from a teaching perspective is to kind of build up some of these core skills. Like we start when I work with somebody who's like coming into investing, has no clue about anything about it, but they know they want to get into it. I start basically from ground one. Like I literally have to teach what capitalism is and how do we create money in in our society. Like Google, as you said, just didn't sprout up from a tree somewhere, right? It started with people who had an idea, who had a vision, and they went out and they built the company. So how do you go about building a company? So I really walk people through really those core first principles, because they set the foundation for then how you, for further analysis and how you go about, identifying these companies. Because then the next level is, looking at risk. Understanding how risky a potential business opportunity is. And then going and layering another level on top of that in terms of valuation, in terms of, okay, this is a great company. It seems to have a really great product, and it's got a lot of customers, and it seems like it's generating a lot of profits, but is it cheap?
Yeah.
Is the stock cheap? And so a lot of times a lot of investors get confused and thinking it's a great company, so I got to go buy the stock. But that's not necessarily always the case.
Mm-hmm. So let me talk about a little bit about what technicals and fundamentals are, because we hear that word all the time, and, I don't want to mention names, and I said this to your colleague as well, but there's people on TV who talk about the fundamentals and the technicals, and it's so complicated for the average person. I mean, I personally, when I hear about that, I just, oh my God, I mean, what is that?
Yeah, and see, one of the things when I work with people, and one of the things I ask people is, like, what scares people about investing, and what totally turns people off about investing? And the number one thing is that I get back is math. And it's just, there's so much, people just, when you flick on the TV and you here's somebody on a business news channel talking about, throwing all these ratios and metrics and data points, it can really freak people out. And so really what I do, and as really working as an investment coach, is really again filtering out a lot of that stuff that's noise and saying, you know what, these are the core elements you need to focus on. These are the core metrics you want to, like, ratios you want to focus on in terms of, understanding if a company is creating tangible wealth. These are one or two type ratios you really need to focus on to understand if this company is has too much debt and could be a riskier proposition. And that's the beauty of what I do, is just helping people filter out all these noise out there, so they can really focus on making a decision based on core, quality, fundamental information.
Yeah. So investing isn't about achieving average, right? It's about achieving goals. And I'm thinking about this. When you want to set goals in a very risky market, or, it's kind of like gambling, isn't it? And also, again, how do you just find a way to not have to participate if you really don't understand all the fundamentals, the technicals and so on, and you depend on a financial advisor or someone like you. I mean, why invest in the market if it's so risky?
Ultimately, the big reason why we invest and why it's important to invest is ultimately we want to preserve our purchasing power. In other words, the money that we save, that we work hard to save for, as time goes on, that money that we've saved, like let's say $10,000, it's actually going to lose value over time if we just, put it under our bed or put it in a bank account. Because the reality is, we have, the prices of goods and services that we need to sustain our living are changing, and sometimes they go up. And so that dollar, can of tuna that costs $1 down the road will cost you $1.50. But if you just still have the same pot of money to live off of, you're going to have to make decisions. You may not be able to afford that. So ultimately, investing, one of the core goals of investing that I teach people is not about beating the market or outperforming the market or doing what Warren Buffett's doing. It's all about preserving your capital and growing your capital enough to at least protect your purchasing power. Right. You want to protect your power against inflation. Yeah. And as long as you're doing that, you're doing fine. But the industry has put in front of us that you need to outperform, or else you're not meeting your goals. Yeah.
Yeah. Now, we have a new president, and as you know, a lot of people are very bullish on the market now. They think that Trump is going to really help them make money because he's trying to keep companies in this country and really give people an opportunity to make lots of money that they didn't have before. In your opinion, is the stock market going to go up or is it going to go down?
Well, it depends. I'm getting this question quite a bit now since the election, and so from some of my clients. And what I do, and again, the beauty of being an investment coach, my answer is always, I don't know. My answer will always be, I don't know. But what I do is I work with people to kind of help figure out an answer or figure out, possible answers. Because investing is about making educated guesses. Because nobody knows what's going to happen. Like, nobody knows. Like, you have a new president, but we really don't know what's going to happen. So all we can do is make certain educated guesses. So your question about, okay, well, is the stock market going to go up now because of Trump? Well, it depends. You have to look at it from a few different perspectives. And maybe we can play like a little mind map kind of game here where you and I can try to maybe figure this out. So how about let's look at one perspective to look at, with Trump is from a perspective of interest rates. Yep. Now, Trump has been, during the campaign, quite vocal and quite adamant saying interest rates have been artificially low. And he has gone quite a bit of an attack to the Federal Reserve, to Ms. Janet Yellen, criticizing her for keeping interest rates too low. So the debate now is, the question is, when he takes power, is he going to just kick her out and put somebody in that's going to be, more conducive to his thinking? Right. So far, what we know is Ms. Yellen has said she's not going anywhere. She's going to serve out her term until 2018. So she's going to stick around. So she's going to implement policy. Right. And based on what we're hearing from the Fed is that they, as soon as, a couple of weeks, interest rates might start rising again. Right. So what does that mean? So for an investor at home, it's like, what does that mean? So ultimately, if interest rates go up, the cost of capital goes up, cost of borrowing goes up for companies, and if it costs more for companies to borrow, that means they're going to pay more interest costs, they're more expenses, and so ultimately profits go down. Right. And if profits go down, ultimately that's not good for stock prices. Yeah, right. So that's kind of like, this is like a typical kind of exercise that I would go through with a coaching client on how to figure this stuff out.
Right. And so we're talking about the fact that it's very difficult to figure things out, but you have to use your, well, I'm not going to say imagination because, but in a sense, it is your imagination because you're thinking, well, let's see. I'll use this as an example. People say Apple, and now Apple is a huge and a very important stock for people to have. It pays a dividend. It's been going up. It has a lot of money. It has trillions of dollars in its coffers. It's a great company. But the problem, unfortunately, is, again, Trump says that he wants to bring Apple back to America. Okay?
Right.
And again, my question for you is, so should we buy that stock? Should we sell that stock? No, again, I guess you have decided and have looked at it a lot. So what do you think?
Well, let's play it out. Let's mind map this. So ultimately, the decision there's two actually issues here with like a company like Apple. The first issue that you cited is that they have a lot of money sitting offshore. And, they have almost $250-300 billion in the bank. But most of it is not in the U.S. Most of it is offshore.
Right.
And the problem is if Apple were to bring that money back today, they would pay tax on it at a pretty high rate. So a lot of companies would just prefer to park their money offshore. Second issue is really all about trade. And that's how what Trump has been quite adamant about is that as soon as he takes office, that he is going to, if not tear up, but renegotiate many of the trade pacts that the U.S. has with other countries around the world. Mm-hmm. And so the question is, if a sort of protectionist element kind of enters the discussion, what does that mean? Like, how do we figure that out? Well, if we start putting up walls and trying to limit flows of goods coming between countries, the reality is most of Apple's products are made in China. So if they start putting tariffs on components, on the phones itself, on the iPads itself, ultimately that's inflationary, right?
Right.
Prices are going to go up. And if prices go up, then ultimately is Apple going to be selling as many iPhones and iPads and Mac computers in the future than they are now? And if they aren't, then that potentially could be leading to lower profits, which ultimately could be leading to lower stock prices. Mm-hmm. That's one element to look at. The second element, as I talked about, is Trump has also talked about quite in depth about lifting or creating sort of a tax holiday where companies who have money parked offshore in other parts of the world can bring it back to the U.S. and pay no tax. And so what would that impact look like? Well, obviously, if they brought their money back to the U.S., then maybe they could use it to develop R&D, develop the R&D in-house, develop a manufacturing capability in the U.S. Mm-hmm. That should be good. That would create jobs, stimulate consumption, and in theory should stimulate the economy, and that should be good for stock prices.
Right.
But the other side of it, too, is we've been living in the last 5-6 years in a very similar type of climate where a lot of companies have been sitting on incredible amounts of cash, but they haven't been really investing it back in their businesses. What they've been doing is just paying dividends or buying back stock, which is just another backdoor way of increasing your earnings. So that's the question we have to ask ourselves as an investor is, okay, if Trump does agree to follow through with these policies that he's talking about, it might create a short-term stimulus for the U.S. economy and for stock prices. But in the long term, are these policies going to be hurting the U.S. economy and U.S. citizens more dramatically? Well, that's the catch.
Okay, I know that's the catch, but you must be thinking about it. You must have sort of your own ideas. So, I mean, I understand that what you do. I understand who you try to reach, but come on, put us in a situation where we have to make a decision. What would your advice be?
Well, my advice would be, as I said, I don't put buy or sell recommendations on specific securities or anything. That is the beauty of what I do as a coach. But I can tell you about strategies. But we can talk about strategies. So right now, if you're a person out there who is saying, you know what, I'm just coming out of school. I know I need to be investing. What should I be doing? Well, what you should be doing, first of all, is you need to be coming up with a bit of a plan. You need a bit of a roadmap to figure out, what are your goals, what are your long-term goals, personal goals, financial goals, and develop them and put it down on paper and create a bit of an action plan to it. And that's something, you can't do that on your own. It's pretty hard to do. Yeah. And so that's ultimately where you would interact with an investment coach or a financial advisor who can kind of build that roadmap to you and help you develop that kind of ideology. Yeah. The second step is then just developing the education side of it. It's just learning about the core fundamentals of how to make an investment decision. Right. And then just doing it and executing it. Mm-hmm. So that's one element, for somebody who is just looking to start investing right now, that's one element that, a path that people can walk down. The second side of it is if you're the person who's, 5 years away from retirement, right, and you're fortunate enough to have a pension, and you have a little bit of pot of money too that you're going to have, kind of as a buffer kind of thing, and you're seeing what's going on right now, and you're going, oh my God, like what, is this all stuff going to be threatened? Like what should I do? Yeah. And the first common thing that people do is when they feel that uncertainty out there is to react to it. Yeah. And a lot of times that's kind of the worst thing you need to be doing. So a lot of times when people come to me in that kind of scenario, the first thing I need to do, I need to tell people just to not panic. Yeah. Because that's the worst thing you can do is start making emotional decisions that are going to hurt your long-term, your long-term plan and hurt your savings. Mm-hmm. One thing I tell people to do, and I work with people to do, is just say, you know what? That investment plan that, that advisor gave you, 5 years ago that you paid a couple of grand for, you might want to dust it off and take a look at it and just determine, what, are those goals that you set out still consistent? Are they still valid? And once you have that comfort level, then it's about execution again. And it's about then coming up with a list. What I call, and it's something I have in my pocket, I have it everywhere, is a list of companies that I like, that I think are well-run, managed business, but I don't want to buy them because I think they're too expensive. And it's just a time like this where I would constantly review my list and look for those opportunities, especially if we're going to enter a period of great volatility in the markets, because a lot of times what happens in markets, when markets go down, is great, wonderful businesses go on sale. Yeah. And if you have that list and you have that preparation done ahead of time, you're going to it's about clinical execution. It's not about emotional reacting to things. Yeah. So these are two common cases that I face quite a bit. Yeah.
Now, we don't have a lot more time, but I do want to cover one more thing. A new rule that proponents say will protect retirement savers, and you mentioned retirement savers, from conflicted advice and inflated fees is looking more likely to be delayed or repealed in the coming months in the wake of President Donald Trump's victory. So what is the rule and why is it suddenly up in the air? I mean, why?
Well, the whole concept really with an advisory relationship, the principle behind when you go to an advisor, what you expect an advisor to do is you expect an advisor to recommend or advise you actions, strategies, specific securities that are in your best interest, that should work for you. And not work for the benefit of the advisor or the company they represent or, the products that they're selling. And so there really hasn't been any kind of mechanism. It's been pretty much like an honor system where, financial institutions uphold this standard of, putting the client first. And the fancy schmancy kind of term for it is called fiduciary duty. Right. And now what happened? President Obama, over the last year or so, or in his administration, has been working actively to kind of legislate this concept of fiduciary duty that all companies and advisors need to follow as they're working with their clients. Mm-hmm. And that has been passed. Elements of it have been passed, and so it's there. Okay, but the thing now is Mr. Trump is now proposing, and he's kind of, again, put it out there that once he's in office, he's just going to get rid of that.
That's right, and that's why I'm going to ask you the next question, and then we're going to have to stop. But if the rule is repealed, can I get fiduciary care without changing to a fee-based advisor? I mean, it seems to me that would be very difficult.
And it's pretty much buyer beware. It's there's no, you can't really assume that any the advisor telling you to go buy this ETF is doing it because, hey, I'm going to get a better commission off of it, or this is better for your personal long-term portfolio construction. That element is not there. And this is really essentially comes to a real heart of the matter, really a challenge that the financial services industry is facing. It's this conflict of interest, really, where, they're in business, right? Banks are in business. Brokerages are in business to make money. They have every right to go out and make money. But what is the balance between making money for the institution and the shareholders and working with their clients, their customers, to, get the value that they need to meet their financial goals? It's a constant struggle that this industry has been facing. And, there's been attempts now to kind of help the customer and help the retail investor, especially after everything we've gone through in the last 15 years, to have that confidence in the institutions. Yeah. And so Mr. Trump wants to go back, wants to backpedal on it.
Well, today my guest has been Aman Raina, and Aman is an investment coach and founder of Sage Investors, a financial education company that works with individual investors to improve their financial literacy. And there is so much more for us to talk about, but our time is up. So if people want to get in touch with you, Aman, and make you their financial advisor, what do they have to do?
If they want to touch base with me, talk about some investment coaching, they can reach me through my website, which is www.sageinvestors.ca. And they can send me an email through there, and we can touch base. I'd be more than happy to touch base with them. It can be anywhere, on the phone, in person, at a Starbucks, wherever. I'm also on Twitter. I comment daily on various market happenings and observations. You can through my tag, or it's called @SageInvestors. And those are my two ways you can get a hold of me.
Well, that's great. So I want to say thank you very, very much for being on my show. And you're an enlightenment. You are giving great advice, and I hope that people, this show has taught people a lot of things, because it's given me a lot of education and information. So thank you so very, very much for being on my show.
Oh, thank you for having me, Susan.
Thank you for listening to The Susan Brender Show. To be a guest, email sebrender@yahoo.com.